Hi, Clint Coons here with Anderson Business Advisors and Law Group, and I would like to take some time to explain to you the 5 reasons why you should avoid self-directed IRAs when it comes to putting your money to use, especially when looking at real estate investing. There's been a lot of talk out there about the benefits of self-directed IRAs, and I just wanted to expose everyone that have tuned into this video to the actual pitfalls that are associated with this type of investing and some of the options that are out there that you may not have heard of. If you don't know me or anything about Anderson, I'll just explain a little bit about it. We have offices in Washington State and Nevada. We have 12,000 clients throughout the United States, and we're a law firm that's made up of attorneys who are real estate investors. So many of the things that people who are interested when it comes to real estate investing, asset protection, tax strategies, we ourselves are engaged in those same similar types of activities. So that gives us a unique perspective when it comes to dealing with real estate investors. We also have a tax practice inside of our firm. We have CPAs, enrolled agents, and bookkeepers. We have offices in 4 different states where we prepare tax returns for real estate investors. And we catch many of the mistakes that CPAs who are not familiar with real estate taxation often miss in preparing returns for investors. And lastly, we have a financial planning side to our firm where we specialize in self-directed retirement plans and 7702 tax-free retirement plans as well. These two types of plans have been extremely beneficial in reducing tax liabilities for our clients, and we will talk a little bit about those later on in this presentation. So let's get started. You may know about this. Here is the typical self-directed IRA pitch that you get. If you've been to any workshops in this country where you go and you learn about real estate investing, you'll typically run into somebody who is talking about the benefits of self-directed IRAs. I was recently at a Dallas RIA Expo event, and there were maybe 600 people there, and there was a convention center set up with all these booths, and of those people who were there with a booth, I would assume that at least 10 to 15% of them were actually companies that offer self-directed IRAs. And each and every one of them was trying to get with attendees and explain to them the benefits of investing through a self-directed IRA when it comes to real estate. But not many of them were telling people the actual entire story. Typically, the pitch goes like this. Do you want to take control of your financial future? Then move your money from your traditional IRA into a self-directed IRA and gain control over those funds. A lot of times they tell you that only 2% of Americans even know about this type of tool, that it is so unique that many people miss the opportunities that are available inside of a self-directed IRA. I've even read that it's used by Warren Buffett, although I have no way of verifying this. And one of the things that really they want to get you into thinking about when it comes to self-directed IRAs is the ability to invest in real estate. And that's what most people who consider this type of vehicle are concerned about. Now, you can engage in other types of investments, such as private notes, loaning money, tax liens and deeds. A lot of things you can do through a self-directed IRA when it comes to investing, but most of it is real estate related. They'll also tell you that incomers receive tax deferred or free. So this is the perfect vehicle for you to invest in an IRA. In fact, it is so easy, even a caveman can do it, you're often told. So the thing about a self-directed IRA, what makes it so easy is all you have to do is open up your IRA with one of these custodians that permit self-directed IRAs and fund your account. Typically, this is done through a rollover where you roll over your existing IRA. Then you go out and you find the investment that you want to put the money into. So maybe it's a house that you plan to invest in or some tax liens or deeds that you would like to buy at a sale. Thing is, identify the investment. Once you've identified it, then you need to just go and merely ask for the funds to contemplate this or finalize the purchase. And after that, the IRA custodian will take over and do the rest. The benefit to you then, of course, is that after this is done, you can manage the investment. So really what they promote to you is that it looks something like this. You're out and about and you spy an investment. You find a house that you'd like to invest your IRA in. You would then send instructions to your IRA custodian that you would like to purchase this house. The IRA custodian then would do their things and they would contact the seller and send the money to the seller. And at that point in time, once the seller has received his funds, then the house would be deeded into your IRA. And like magic now, you now own real estate inside of a self-directed IRA. This is the pitch that everybody that is out there talking about self-directed IRAs is convincing individuals like yourself, if you may be a real estate investor, why you should consider this type of tool for your real estate investing. But what are they hiding? Well, they're hiding a few things. Number one, in that example I just gave you, you cannot sign contracts. That is considered to be a prohibited transaction. So you actually have to give your IRA custodian the right to sign it. So let's assume that you're out one weekend, you're driving around, you see this tremendous deal, you want to close on that deal. Well, unfortunately, you cannot sign the paperwork. You can't give the seller any earnest money. You can't sign a contract with him to tie the house up. You have to tell him, wait, will you hold that deal for me for a few days until I can get my IRA custodian involved so he can finalize or put this transaction together for me. You cannot buy at auction because in order to buy at auction, as many of you know, you have to have cashier's checks. But because the IRA custodian is involved in the transaction, you won't be able to go to the auction with cashier's checks because it's your IRA custodian that needs to handle the deal. Many times people are chagrined to find out that a purchase agreements can take up to 14 days to complete because you need to send in information to your IRA custodian. Then your IRA custodian is the one that needs to sign off on the purchase and sale agreement and sign any subsequent documents that are required in order to close on that property. The other thing they may not tell you is that distributions are not protected from creditors. So actually, when you start pulling money out of your IRA, if you were involved in a lawsuit and there was a judgment against you, your creditors can actually take those funds from you. And the big one is that most people are married that invest in real estate. There's a lot of people out there, a husband and wife, they each have their own IRA, and maybe they want to partner together in real estate. In order to accomplish that, each of them will have to set up their own self-directed IRA. And if you've done this, you know these come with substantial fees. They're not inexpensive to create. And in fact, on an annual basis, the IRA custodian will charge you a percentage of the assets under management, that is the value of the IRA, or they may charge you on a transaction basis. So there's a lot of hidden fees that go into self-directed IRAs that are not typically disclosed when you first set it up because you get so wrapped up in the idea of being able to take funds that have been locked up for such a long time and then put them to use where you can control them. So, limited annual contributions. There's one more problem with self-directed IRAs. You're capped on how much you can contribute on an annual basis. $5,500 per individual is all you can contribute. So, is there a workaround for this? Absolutely there is. Typically what the self-directed IRA custodian will tell you is, if you see a problem with the issues with buying a house where you have to wait for us to get off of our tails and actually put the agreement together for you, why don't you set up what they term to be a checkbook limited liability company? And that is create an LLC that is owned by your IRA. You can manage that LLC, and what we will do is move your money from your IRA into the LLC, and your IRA then becomes the sole member of that limited liability company. Once that money's in there, you as the manager have the ability to go out and find a property, sign all the contracts on behalf of the LLC, and then actually close on that property and own it in this LLC, which is in turn owned by your self-directed IRA. So it's simple as this. You create an LLC, it's owned by your IRA. Keep in mind, you cannot do this. You have to hire an attorney to do it. Otherwise, it'd be a prohibited transaction. You move money into the LLC. You control the LLC. You make the investments. So what are they not telling you about this particular strategy as well? Well, here's what they're not telling you. You cannot work for your limited liability company, performing accounting services, dealing with tenants, managing the property. These have been held to be prohibited transactions. That is, if you're the manager of this LLC, you have to step back and hire all of this work done. Otherwise, you're making an impermissible contribution of your services to the IRA. Remember, this is an individual retirement account, and basically you're not supposed to be involved in the day-to-day running of those investments. Your job is to select the investments, but not participate in them where you actually can add value to your IRA. So that's one problem that comes into play when you set up this type of transaction, because you might assume that as the manager you can engage in these types of services and it would not be a problem. You can't borrow from your IRA. That's a prohibited transaction. If you use debt when you acquire real estate, let's assume that you go out and you acquire a loan on behalf of your IRA or your LLC to close on a piece of property. Well, provided that loan is not a recourse loan to you personally, that is, you didn't sign on it to guarantee it, the use of that debt creates a taxable event inside of your IRA. A lot of people miss this that I run into. They've used debt in order to acquire real estate, and they're not properly reporting it on their tax return as taxable income to the IRA on an annual basis. So we have these problems that you're not finding out about this from your IRA custodian. In addition to that, we have a number of issues that have come up with the IRS. Beginning in 2014, the Internal Revenue Service is beginning to look at self-directed IRAs. They've already expressed this in countless announcements for the past 2 years, and now we're seeing a ramp up. What they're looking for is how are the assets being held inside of an IRA? That is, what assets are inside of there. And as a result of that, we have new reporting requirements. That is, your IRA custodian has to report to the IRS if your IRA owns real estate or it owns any limited liability companies or other business interests like limited partnerships or corporations. In addition to that, audits of prohibited transactions are on the rise. Is that you've already seen the IRS start to look at IRAs and audit individuals who have been investing in real estate. Essentially, the service sees self-directed IRAs as the Wild West right now when it comes to investing. That is, they've been unregulated and they've expressed their intent to go in, take a look at the transactions that have been taking place in these, and if they find prohibited transactions, they're then going to tax these transactions. There's going to be penalties on these transactions, and possibly they may invalidate your IRA altogether. So this reporting is something I find to be particularly troubling for us as individual investors if you have one of these IRAs set up, because this is the new box or the new form, the 5498 form, that the IRA custodian must send to the IRS on an annual basis. And what they've added to it is this box 15A and 15B down at the very bottom. Fair market value of certain specified assets. And they ask for a code, and the code corresponds to the types of assets. And you can see I've highlighted them here, that they want to know if your IRA owns real estate, owns interest in a partnership or trust or similar entity, option contracts. So why would they change the form to ask this? It's pretty straightforward, if you ask me, that they're specifically focusing on these types of investments now, and they will then target those IRAs that have been shown to have invested in real estate or LLCs and closely held business interests. Now, some of the common questions I get when it comes to investing through a self-directed IRA would be, what happens if I've already engaged in a prohibited transaction? What should I do now? Well, first thing I would do is, if you think you've engaged in any type of prohibited transaction with your IRA where you've gone out and you've done something on the property, if you own real estate there, such as painting the house, adding any type of value to your IRA from a service standpoint, the best thing you can do as an individual, I believe, is roll out of that IRA. Maybe set up a new IRA or hold on, and I'm going to show you a different option for you. But you should consider closing that down sooner rather than later to make that one just go away. People often ask me, can I pay myself for managing my IRA? The answer to that is absolutely not. You cannot pay yourself for managing your IRA. Just the other day, I was asked if they could collect rents on behalf of the IRA, that the IRA custodian would not receive the rents, and this person was receiving the rents on behalf of their IRA and then forwarding it on to their IRA custodian for deposit. That would definitely be considered a prohibited transaction. So the question might be then, how would you get those rents to the custodian if they refuse to accept them directly? Well, then you have to hire a property manager to collect them and then send them over to your custodian. Somebody asked me if they can assign a contract. So I have a real estate investor client who was going out, they found a property, they put it under contract, and they wanted to take it in the name of their self-directed IRA. Well, once they put that property under contract, they could not assign that to their IRA because that would be considered a prohibited transaction. You're now contributing something of value to your IRA that is not cash. So that's a problem. If you need to loan money to your IRA, you see this a lot, that people buy real estate, they don't have enough cash in there to pay for expenses that come up or pay for property taxes, then they loan money to it. That is a problem. When it comes to self-directed IRAs. In fact, I just spoke to someone who bought a apartment building inside of their IRA. They were managing the apartment building. They were not charging any fees for their management services. So first off, their managing the property was a problem, and they were living in one of the apartments inside of this building. There were two glaring prohibited transactions that if it's picked up, there's going to be problems there in a day of reckoning for them. Can I buy a house with personal and IRA monies? Basically, can you and your IRA come together and buy a rental property? The answer to that, if you did it directly, is no, you cannot. So these are some of the issues of associated with IRAs and reasons why I would avoid self-directed IRAs because of the problems associated with the investments that the IRS is looking at it and the numerous issues I just raised that typically your IRA custodian is not telling you when they're convincing you to put money towards this. So if you really want to take over control and you want to gain access to your funds and you want to do it in a way that's going to reduce IRS scrutiny of you, give you ample control over your investments, then what you need to consider are qualified plans. These are self-directed plans. Profit sharing or solo 401k plans are the two plans that I have found to be best when it comes to dealing with real estate and allowing someone to self-direct their investments. With these types of plans, you connect it to any business entity that you own. So it's actually just like your employer's 401k plan, but it's a much smaller version for you that you can create. And when you create this plan, you are the trustee. You're the one who controls the investments. We've taken the IRA custodian completely out of the loop here. You're the one that has complete control over anything that takes place inside of that plan. Now, it doesn't mean you can pay yourself to do this, but it gives you a tremendous amount of control over how the assets are managed. So some of those problems that I just brought up in the past about collecting the rents, dealing with the tenants, you can do that because as a plan trustee, that is your job. You are required to do that because you have a fiduciary duty to the plan and its participants. It just so happens you happen to be its only participant, or you and your spouse. Now, you might be thinking to yourself, great, Clint, I can set up one of these plans off a business entity that I have. Maybe it's an LLC, but where does the money come from to fund it so I can go out there and start investing in real estate? Well, first off, look at it this way. Let's say you have a real estate LLC that you've set up, or a corporation or some entity that owns real estate now, or could be engaged in any type of business. All you have to do is adopt this solo 401k, and then you have 2 or 3 sources of funding. Number one, your business could fund the company. That is, we could pay over money based upon salary that you pull out of your business. You could turn around and use those funds to put a portion of those into your solo 401k or your profit sharing plan. So there's one method of funding. Another method of funding would be rollovers. Actually, that self-directed IRA that you've been having problems with and you're not happy with the way it's being run because of all the restrictions, you can roll that into a solo 401k. One caveat here, it cannot be a Roth. It has to be a traditional. If you would also want to look for other options, you can have your spouse fund the IRA as well. So you actually can pool accounts inside of one plan. So she can roll over her IRA, you can roll over your IRA, put it in one account, and then from there you'll direct all of those funds. So with qualified plans, as the trustee, you have the flexibility to sign contracts, make payments. You can manage the investments. You can handle the accounting inside of the pension plan. You can deal with the tenants. You can also loan money. In fact, when it comes to setting up these plans, you can make any permissible investment that is provided for under the code, and you're the one that would handle everything. I started off with an example. If you're driving down the street on a weekend, you see a house that you'd like to purchase, and you have to go to your IRA custodian to put that deal together. No longer. When you drive down the street on a weekend, you drive with a checkbook on behalf of your plan. You drive with the control to find property, to close on that property, to write the earnest money and buy it in the name of your plan without bringing in a third party to deal with that transaction. So with qualified plans, you can also borrow from them. Unlike an IRA, which prohibits you from borrowing from that type of account, with a qualified plan, you can borrow up to $50,000 out of your plan. As I stated earlier, you can pool accounts with your spouse. You can make annual contributions of up to $52,000, far in excess of the $5,500 you're limited to with an IRA. Distributions from qualified plans can be protected from your creditors. That is, if you're ever involved in a lawsuit later on, you start pulling money out of your plan, your creditors cannot attach those funds. Another aspect about qualified plans is that debt is not taxable to the plan. That is, if you borrow money to invest in real estate, that is not a taxable event for you like it is with the self-directed IRA. I mean, when people ask, why would they set up a plan versus an IRA? I often ask them, why not? I mean, there are just so many added benefits of having a qualified plan over and above the self-directed IRA. It just makes sense. If you want to invest in real estate, this is the type of plan you should have for your real estate investing. And last but not least, here's the zinger. You can actually partner with your own plan. That is, you and your plan can go together and buy real estate together if it's set up correctly. So when I say checkbook control, what does that mean? Well, let's look at it. Here you are, you have a solo 401k, there you are as the trustee of your plan. You see this real estate that you would like to buy in the name of your plan. All you would do is contact the seller of the property. Once you've contacted him, you can negotiate the purchase and sale of the property. You'll sign all agreements, and then you'll cut the checks to the seller, and then the property will be owned by your plan. It's that simple. I've actually talked to people before who've told me they've lost deals because their self-directed IRA custodian could not put the deal together quickly enough for them, and they lost it to another investor because the seller was unwilling to wait. Other types of transactions you can engage in on inside of a qualified plan. As I stated earlier, you can partner with yourself on a new deal. You can partner with another person. You can borrow money from your self-directed pension plan to fund a deal. There's just so many different things that you can do there. I'm just scratching the surface of a qualified plan. I'll give you an example if you wanted to partner with yourself. If you wanted to invest in real estate with the funds inside of your solo 401k or self-directed pension plan, all you would need to do is create a limited liability company that's owned by you and your pension. You want to make sure that the percentages are equal to your contribution, and then you could move money from your own personal account, from your 401k account into the pension, and then you could use those funds to go out and buy real estate. Now, this is a bit aggressive, but it can be done if you do it right. But I want to put one caveat here. You do not want to do this on your own. You need to work with a law firm like Anderson or another qualified attorney who understands how these transactions are set up. So number one, if you're going to set up the LLC, you have to hire an attorney to do it. Then you'll fund the LLC from the pension and from you individually. So both you and the LLC are members in that limited liability company, and you are the manager of that LLC. Now, the one thing about this transaction here is that you can only fund the entity one time. That is, if you're going to buy a piece of property, I just dealt with a client the other day on this. They figured the property was going to cost them $300,000, and they wanted to partner with their IRA on the transaction. I asked them, what are the rehab costs? And they say, we expect the rehab cost to be about $65,000. I told them, and you need to put enough money in there to cover the rehab cost and have a buffer on that initial funding, because once you've partnered with your IRA, with your solo 401k or your pension plan with an LLC, you cannot go back to either yourself or your plan for additional contributions. It's a one-shot deal. So make sure you have plenty of money in there to make this deal come together. So once you've done that, then there's tremendous opportunities. So you could go out there, you could put in, they say total $400,000, you sell the house for $600,000, and then you would split the profits, assuming that it was an equal contribution and distribution there, 50-50 with your solo 401k or your self-directed pension plan. You can also borrow money from other people to put deals together. So you can go out there and you can find lenders. You can borrow money from them, and then you can buy real estate, leveraged real estate inside of the plan. Now, if you're going to do this, make sure that when you're borrowing money that the person is unrelated to you, that your plan gives the lender security interest against the plan assets. The debt, again, as I stated, is not taxable to the plan. And last but not least, you do not sign a personal guarantee with the lender. You cannot do that. So these are non-recourse loans. And if you're interested in somebody who would actually give you those, there are a few companies out there that I am aware of that will loan up to 70% LTV on properties. That is, they will give you a non-recourse loan where you do not have to sign personally. They will only look to the real estate if they ever had to foreclose because you weren't making your payments. Now, if this excites you, like I know it does right now, because every time I explain this to people, they were just like, wow, Clint, why didn't somebody tell me about this sooner? I thought the self-directed IRA was the only tool that I had to be able to invest in real estate with my IRA funds or with my rollover 401k funds. Fact of the matter is, the people that you're hearing this from are individuals who make money off of maintaining funds inside of their custodial accounts. They don't have any incentive in giving you actually the true control that comes from setting up your own plan where you're the one that's in control of the investments. So if you'd like to find out more about creating your own truly self-directed plan, call us at 800-706 4741 to schedule a free consultation, and we will discuss with you the ins and out of creating your own self-directed plan so you can roll over your IRAs and begin truly self-directing your investments. My name is Clint Coons with Anderson Business Advisors, and I want to thank you for watching this short video.